Hello and welcome to the latest edition of TradingView. I'm joined here by James Helliwell, who's Head of Research at the Lex Van Dam Trading Academy. How are you today, James?
I'm well, thank you. It's good to see you again so soon.
Well, yes, making a habit of it now, really. But it's nice to be here in the TIP TV studio, isn't it?
It is.
Nice
It's a Friday feel as well. So after
Ex-
all the central bank nonsense this week, we've finally got a little bit of tranquility in sight.
Well, not if you're long of dollar yen, I suppose.
Not quite, but if you are long dollar yen, you're a naughty boy.
But it seems to be the same pattern again. The talking up, the media saying there's a big bazooka on its way, trillion, I don't know what comes after trillion, quadrillion, in stimulus,
Yeah.
and then, oh, it's disappointing.
It's jawboning, as they say. It's what central bankers do best, and it's the only thing they do well, in my opinion. So whether or not this is a repeat of the 28th of January, I believe it was, when the market just had lost confidence in central banks, in the Bank of Japan specifically. Whether it's another one of those scenarios, I personally have that view. However, from what we were just discussing off air, having come in, it does sound as though things are maybe up for review at the BOJ, or there was hints of that. So
yeah, well, it's either a review and trying to review or restructure what they're currently doing, or which means that they're sort of throwing the sort of the white flag,
yeah.
or we're actually going into the helicopter money phase, which actually the market would like. So you can't celebrate if you're short of dollar yen, and you can't, we're in a bit of a no man's land now.
It is no man's land, I would say, between 100, the pivot low, and 106, 107.
Right, okay, well, let's have a look at the slides, what the people in the market are putting up on TradingView. Ray Log, the legendary Ray Log, he's looking at gold at the moment.
Gold here. So this is a daily interval that we're looking at here. So I can see some Fibonacci going on from the 23rd, so that would be the 24th being the Brexit outcome day, the referendum low, which is around 1250, or as you can see on the chart, 1246.88. So drawing the low from there up to 1375, the high. Looking at the retracement levels, it appears as though, as I have been on this chart, it appears as though it has a lower projection than I had personally, which was for a pullback to a maximum of 1297, so just around 1300. Here it looks as though Raylog is, as a contributor, is making a call for around 1271, which I can see makes sense, or makes some sense from the extension of the retracement, 1.62%. So I think with gold, with the speculative positioning, also is at a downtrend line there. With the speculative longs in gold, they have been liquidated, or being liquidated, being reduced over the last couple of weeks post-jobs, so on a stronger number. However, if we see yields head lower again, and now the dollar-yen correlation is perhaps, if dollar-yen sells off, is moving again in the favour of gold and is supportive of gold prices, we'll have to see whether we get a correction to that. I don't think it's out of the question in terms of positioning. Fundamentally still bullish on gold, of course, as I have been all year. But in terms of retracement, I think that seems reasonable. So it's quite a nice bit of Elliott wave and Fibonacci applied here.
Okay, well,
what are your thoughts?
Well, no, my view is the time for gold to break down was ahead of the Fed and ahead of any steering that they'd come up with. I think that now we're in nearly 2 months of, it's 2 months till the September meeting. And unless there's something spectacular comes out of Jackson Hole, so to speak, then really gold looks to be favoured. And it's just the same old thing that the Fed, it would do anything. It seems like it would do anything but not raise rates again.
Oh, absolutely.
So, Trump is a danger, Brexit's a danger. There's a cloud in the sky which has gone over the sun. That's a danger. I mean, anything from anywhere, it seems to be their excuse.
And good economic data and record economic surprise. I've actually got here, for a shameless plug, I've got a copy of the weekly market report from the Lex Van Dam Trading Academy here as a shameless plug. Unintended, I jest. But what you can see on this, and what I'm referring to here, is the speculative positioning in some of the commodities, as I did a moment ago, but also the economic data. So we have the City Economic Surprise Indices, and as I referred to on yesterday's show when I appeared, the Economic Surprise Index, which measures how data has come out in the US broadly versus economists' expectations, which is generally wrong, I should add, it's as strong as it's been in basically 2 years. And in fact, up until March, it had been negative below zero for over 18 months, since like 2014. So it's quite a seismic change there. And the fact that yields haven't gone up in that time significantly, they've gone down over that period, if we're looking at longer term, is somewhat surprising. So if they're not going to do it now, and the week-on-week change in the S&P 500, with it being at all-time highs, is also very positive, and the Fed kind of unofficially marked their views of the policy according to the level of the S&P, some say. When on earth are they going to raise? So I absolutely agree with that.
Okay, well, let's move on to the next contender, which is the market at the moment. It's now down to around 103.50. So this is from Quantum Logic Trading, which sounds like a very important organisation. But here we have the cross, as I said, the cross at the moment. It's just down. It's down, isn't it? Down,
it is.
down, down.
Yeah. So I think the interesting thing with this, having actually read the very detailed analysis, at least the summary of the very detailed analysis on this this post from this particular contributor yesterday, it's very much derived. The moves and the levels were derived from the options market, and far more complex methodologies than I can possibly attest to understand or could explain live on camera. But basically, the demand for upside calls relative to puts was far greater, or the volatility as a measure of demand for those options was greater. So the skew was, as we say, was tilted to the upside, favouring an up move. Clearly, that was wrong. Not from the contributor, but the options market was wrong. So that was a misleading indicator. Could have been hedging, could have been anything. What the options market was telling us and was implying earlier in the week, aside from direction, was that they were expecting a 3% move in either direction. And in fact, we've got a 2% down move, so strengthening of the yen, dollar yen comes in to 103 overnight. So in fact, the move in terms of magnitude was actually below expectations of the options market as well. There's just so much anxiety amongst traders going into this that, things in the end must have disappointed slightly. Few trillion less yen than expected. Announced, no further cuts and so on. The move wasn't as great magnitude, but significantly it was to the downside rather than to the upside in dollar yen. So the yen has strengthened, contrary to still huge amounts of easing. So again, it's a vote of no confidence in central banks and in QE.
Okay, next market, we've got Mary Jane, who's looking at my favourite market, the DAX.
Yeah, the DAX is an interesting one. European equities as a whole, on a relative basis to the rest of the world, and in particular the US. From a valuation perspective, not going too far into fundamental drivers, which clearly are really quite divergent at the moment for the two. However, on a valuation basis and also a technical basis, it does look as though Europe has got to do some catching up, and particularly Germany. I've actually got on here, we've just come from recording the monthly club meeting this morning, actually Alex and I, and one of the trades that we have on is the S&P versus the DAX versus the S&P for the coming month. And what you can see is that basically the DAX is, on a valuation basis, forward sales, forward earnings, it's cheaper than the Euro Stoxx 50 and pretty much anything else you can find there. I think the PE is like 11.7 versus 16.5 on the S&P, and MSCI World is even above that, about 14. So it does look relatively good. Getting back to the technicals, here I can see Mary Jane, I must say hello. It's, I believe she's the third person to send me a private message about trading on TradingView since I got on there this month. So hello to her.
Lots of friends on there. I might have to join myself, you know.
It's been great fun over the last couple of weeks.
Wonderful.
It's a great platform. But having a look at her analysis here, I can see a potential break, as she highlights here, of that downward sloping trend line. And yeah, fundamentally, I do believe that the DAX personally has got some catching up to do. So this just confirms on a technical basis the timing of that potential move.
Okay, well, saving the best till last.
So this guy needs no introduction, as I'm.
He's not going to get one either.
No, so this is my analysis as we featured and discussed yesterday, you and I, when I came on the show to discuss other bits and pieces, and basically we're looking at crude oil, and this, for the time being, has returned or resumed being the most important chart in the world. And the reason I say that is, okay, arguably the dollar has been the fixation and the primary driver of the market, certainly over the last 6 months or so, with it softening a little, things have reflated, precious metals and so on, as we've seen yields lower. That should be positive for crude, and it had been. But now the dollar's kind of strengthened a little, not significantly, it's still within the channel or the range, provided it remains range bound on the dollar index. We should expect a bounce in crude at some point. The inventory data wasn't too great this week, as I highlighted yesterday. I don't think the bulls or the bears have a particularly strong view on either side, fundamentally. So at the moment, it's very much a dollar, or it has been a dollar-driven trade. The reason it's now the most important chart in the world, I feel, is that it dictates or it determines whether we're facing the risk, the bond market's facing the risk of an inflationary shock going into the first quarter of 2017. The implications that has for the reflation trade, a continuation of the reflation trade, which has led, and value outperforming growth, which has also led an emerging markets throughout year-to-date 2016. But in terms of finding a technical level here, it does appear that the $41 level will be broken, the retracement level, and it looks as though 39 is logical, which is a 50% retracement off the 2011 high, possibly seeing 36 if we see a deeper correction. But at that point, it's do or die. A break below there will mean that we're destined for new lows, and that, for sure, would invalidate the reflation theme, and it looks like we're heading for deflation. Everything changes.
Wow, do or die. James Helliwell, Head of Research at Lex Van Dam Trading Academy, thanks for coming in today and helping us with TradingView.